It's been another up and down week for NIO. After gaining about 5% on Monday, the stock dropped back to its lowest price since April and is down 49% in 2024. So is it time to run or is it time to buy the dip? Two analysts are now expecting NIO stock to double. This is a must-watch video for NIO investors, and I will look at the very latest NIO news, analyze NIO's recent financials and current trajectory, and compare these with the likes of Tesla before Tesla stock took off in 2020. If you're a NIO investor, then you need to watch this, but before we get into the video, if you find any value in this, can I ask you to smash the like button? It literally costs nothing, but it helps me out so much. I'm aiming to get 500 likes on this video. Help me hit that goal. Subscribe to the channel if you're new and hit the bell notification so you don't miss out on any new content like this. I want to point out that I'm not a financial advisor and this is not financial advice, so always do your own due diligence and try to answer the question later in the video. But for now, let's get straight into it. So first I want to take a quick look at last week's NIO sales. NIO's vehicle registrations in China were 3,400, down 2.86% from 3,500 in the previous week. NIO delivered 20,500 vehicles in May, surpassing July 23's record of 20,462. That was up more than 200% from 6,155 vehicles in the same period last year and 31% from the 15,620 in April. NIO has guided for second quarter deliveries of between 54 and 56,000 units when it announced its first quarter earnings on June 6th, implying that June deliveries are expected between 17,800 and 19,800 units. Now just look at this graph. For NIO to achieve its expected deliveries this month, that would mean that NIO needs to record two of its very best ever weekly sales. If only 6,900 deliveries in the first 2 weeks of June, that means we should expect between 11 and 13,000 over the next 2 weeks. This will likely drive the share price up in the near term at least, but also look here at the same period last year. It wasn't until week 25 that sales really took off, and judging by these numbers, we can expect similar over the coming weeks. So looking at NIO's balance sheet, we can see that they have total assets of $14.4 billion and total liabilities of $11 billion. Over the past 3 months, there has been a decrease to both assets and to liabilities as the company has burned through some cash, but have also reduced their trade payables and other liabilities, meaning the total shareholder equity remains about $3 billion. Looking at NIO's income statement shows us some very interesting figures. Firstly, revenue is actually down on the same period last year, with revenue having decreased from 10.6 down to 9.9 RMB. Now, as we know with a growth company like this, seeing revenue declining year over year is a very bad sign. However, there is some reasons for this, and it's not entirely NIO's fault, which I have talked about before. But there is a very big positive in these numbers too. Although revenue may have dropped about 5% year over year, the gross profit from that revenue has grown over 200%. We can see that here. Gross profit of 162 million on 10.6 billion in Q1 2023, but now a gross profit of 480 million on 9.9 billion RMB in Q1 2024. Now, for anyone who likes to look at the percentages, that means in Q1 last year, NIO's gross profit margin was just 1.5%, while it has now increased to 4.9%. NIO's gross profit on vehicle sales is actually about 9%, but this still lags behind its rivals, while its other sales of 1.5 billion RMB actually produce a loss. Now, I've been asked loads of times to compare NIO with Lucid, but there really is no comparisons. Lucid had revenue for Q1 of 172 million, and from that there is a gross loss of over 700 million in just a single quarter. So comparing NIO with its peers such as Xpeng and Li Auto gives a far more accurate comparison. Xpeng have achieved a gross profit of 15% on sales of 5.5 million RMB, while Li Auto have achieved a gross profit of over 19% on their revenue. And this highlights a couple of things to me. First of all, NIO is actually making a loss on its services and other sales. Now this should not be happening, But when you consider the amount of money that NIO is investing in its infrastructure, an argument could be made for this. Secondly, NIO's gross profit on its vehicles is improving, but it's still far too low. Gross profit might have increased 200% in a year, but at only 5%, it would need to increase another 200% just to get on a par with its rivals Xpeng and Li Auto. Even Tesla, back in the day when Tesla was operating around the same level as NIO is today, was achieving far greater gross profit margins. Back in 2017, Tesla was achieving about 12% gross margin and making heavy losses. But 2017 was a pivotal year for Tesla, because this was the beginning of sales beginning to skyrocket, and this is the exact same position as NIO might be in right now. But a few things could be holding NIO back. But before I talk about these, if you are enjoying this video and like my analysis and comparisons, then like the video and drop a comment below telling me what you think about NIO now in 2024. As I said, a few things are holding NIO back, and this latest development does not help. The fact that major markets around the world are starting to place tariffs on Chinese EVs. Earlier this month, the EU disclosed tariffs on vehicles shipped from China, which could rise as high as 48% beginning on July 4th. This followed an investigation on subsidized Chinese EVs. In 2023, Chinese-made EVs accounted for more than 20% of all EU EV sales, and that figure is expected to rise to 25% this year. Last month, US President Joe Biden announced a 100% tariff on Chinese-made vehicles as part of a package of measures designed to protect US manufacturers from cheap imports. And now, the Canadian government is considering implementing new tariffs on EVs made in China too. The good news for NIO is that the US and China will not really affect NIO, but the EU tariffs will impact NIO's expansion into Europe. However, in the past few days, NIO CEO William Li has addressed this, saying that the company's upcoming models under its third brand, Firefly, will still be competitive in Europe. Europe is a global role model for clean energy and sustainability, but now imposing additional tariffs on Chinese EVs is a conflict of interest. Li noted that in the long run, the internationalization of car companies will need to rely on localized operations. After reaching a certain local volume, NIO will actively consider local plans. It's something that has to be done to go global. Now, how exactly Li plans on doing this is still unknown, and it will affect profits, but the company is still expanding rapidly into Europe, with a new NIO house being opened in Germany this week too, which is NIO's 4th in Germany and 8th in Europe. Now, analysts in general have been very bearish on NIO stock in 2024, but they have price targets set as low as $4 and as high as $16. The consensus price target is $7.55, which is more than 70% upside from the current price, and according to Citigroup analyst Jeff Chung, NIO stock could still double. According to Chung, not only is NIO stock a buy, it's actually a stock worth $10.40 per share, more than twice its current price. While Chung lamented that NIO will probably continue losing money in the second quarter, he noted that with the sales momentum, NIO will probably exceed analyst expectations for deliveries this quarter, selling about 56,000 cars, and at continually improving gross profit margins, rising to about 8%. Now, that might not sound like very much, but 8% isn't far below Ford's 8.6 gross margin. NIO is growing from a far smaller revenue base, and its stock has the potential to outperform. But what do you think of this? 8% might not be far behind Ford's 8.6% margin, but it is a long way behind the other EV companies. There is a lot of talk on social media right now about NIO stock, but always do your own due diligence. Remember that I'm not a financial advisor and none of this is financial advice, but if you enjoyed this analysis, then please like and subscribe. I hope you make a load of money on this stock. Follow me on Twitter and I'll catch you in the next update.